Blessings, 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 and good afternoon. Welcome to another live from Secure Your Energy. Welcome, welcome, welcome. All right, so we went on a little bit early today, so I hope all you guys catch it this evening when you get off of work. So today we're going to be talking about mutual funds. What are they? What are they? What's the pros and cons to investing in mutual funds? And a little bit more about asset management versus investment banking. So we're going to go over a few new terms, a few old terms like we always do. But we're going to first start off with a little commercial from our sponsors.
Not only makes buying gold affordable, but offers an exciting way to look at gold from a whole new angle. Introducing Carat Bars International. Whether you're a first-time buyer or a gold veteran, Carat Bars International is attracting even the most discriminating buyers. What's causing all the excitement? The Carat Bar. About the size of a credit card, these beautifully designed cards contain a small denomination of pure 24-karat gold bullion framed inside. People love Carat Bars. They're affordable, a whole lot of fun to show off, and most importantly, Carat Bars are real currency in denomination sizes you can actually use. For example, can you imagine trying to pay for a bag of groceries with an ounce of gold? It's just not realistic. That's why Carat Bars makes perfect sense. A gram of gold is far more manageable. Ready for your Carat Bars? No problem. Simply create a free account and have them delivered. And while you're at it, you may also want to consider their exclusive gold savings plan. Easy to use and simple to understand, this revolutionary new feature was created to help you acquire more gold each month through small monthly purchases. However, it's important to realize that you're not actually purchasing gold. Rather, you are simply exchanging your paper money for a superior currency, something far more stable. Now, are you ready for this? Introducing Carat Bar Collector Cards. Customized cards like this are rare and have the possibility to exceed their purchase value many times over in the years to come. For example, this limited edition of Pope John Paul II will undoubtedly sell out very quickly, as only 100,000 of them were created. And, as you can imagine, they make great conversation pieces and fantastic gifts. Carat Bars International was founded by Harold Seitz with the goal of making Carat Bars a household name, and it's already happening. Carat Bars are accepted and recognized as currency all over the world. This creates enormous potential for you. You see, whenever a Carat Bar is purchased, commissions are paid. For every custom card purchased, commissions are paid. Each and every month, when gold is purchased through their very popular gold savings plan, commissions are paid. These commissions flow not just to the person who directly referred them, but paid generously through multiple generations. They even offer company-wide bonus pools, allowing you to share in the profits of the entire company. And as the demand for Carat Bars grows, so does your opportunity. So let me ask you this. How much money do you want to make?
All right, so get in on the program, get that commission, baby, because it's pretty good when you're stacking up free gold. So we're going to get to tonight's broadcast. Welcome, welcome, welcome. I was like, should I be MIA today? I may be MIA on other broadcasts, but not today. So anyway, we're going to get started with today's broadcast, and we're going to start talking about mutual funds. Mutual funds, what are they? And what sparked this conversation right now is not only because it's in the realm of economics, and we have to know what are good investment tools, but happen to just been going over my mutual fund that I invest in, which is Franklin Template Investment as a student investment account. So while I'm going over my end of the year taxes, how much bills I paid, how much money I made or whatever, those investment accounts as well, you have to take into account. And what was troubling to me was that I made more investment into the account than what I'm seeing in the back end at the end of the year statement. Not only because of the fees, but it seemed to not make any money. I had this investment account for my kids for since 2014, and the trend has been consistent. So I want you guys, and as well as new people who are coming in. Welcome to Secure Your Energy. Here we're going to be talking about economics, learning new phrases, old phrases, going over things so we can make better sound decisions. So one of the things we have to make better sound decision is where we put our energy into, and our energy goes into these companies and whatever they're into and what they invest. So with mutual funds, I want you to understand how loose of a grip we have as investment partners into that market, because you're a partner. You shouldn't be a customer. You should be a partner in anything you do, and you should understand it. So let's start. Let's start. And if you haven't visited the website, visit the website Secure Your Energy, where I have some videos for you to learn a little bit more about gold and why it's important to secure your energy, some of your energy in gold. Not to say don't keep paper money and not be into other investments, but it's good to stay well rounded and pretty much keep a diversified portfolio. How about that? So we're going to start with investment banking versus asset management. Know the difference. Short video. We may watch the whole thing or we may not. We got a few videos to get through today, but it's some good information that you need to know. Some of them are really short. Some of them are probably like 5-10 minutes, okay? But deal with the process. You already know I'm going to make it entertainment as possible. But as I tell y'all, everything cannot be entertaining. Some things are dry, but you have to sit through it and learn so you can make better decisions for your household and yourself. Because like I said, when you make a good decision, it is like a ripple effect. It's called the monkey effect. So when you think properly, people around you start to think properly. You may not understand it or you may not believe it, but that's how life works. So if we have a good body of the collected 99% that's thinking accurately and knows exactly where they want to put their energy into, we'll have more control over the market, in which we really do, because we are looked at as the consumers in the investment pool where most of the money comes from and most of the energy comes from. So now we need to learn how to utilize our tools properly, and that's what we're here doing. All right, so let's watch this video together.
Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a tutorial on investment banking versus asset management. Many a times this thing happens that, with students, with the employees, they are not able to decide where they should go, what is right for them, what exactly will be more beneficial for them. So they are into this dilemma that is investment banking good or is asset management good? So my one single answer to them is, what is your passion? What you are passionate about? What exactly you want to do with your life? So it's fine. You still are not clear about that. We'll discuss that in detail. See, the very basic of investment banking as well as the asset management, it lies in the very basic of investment banking as well as the asset management. It lies in handling the money. Okay, many students find it very challenging to make the career choice between the two, owing to the competitive salary package both of them offer. The latest statistic reveal that investment banking as well as the investment management firm offer the highest starting salary. Okay, so that is good for graduates. Both are fiercely competitive industry, and they hire the best talents from the world's top university. Most of the financial graduates or postgraduates, primarily they are MBAs or they do CFA, that is Chartered Financial Analyst. So let's see the conceptual difference between investment banking and asset management. Now, investment banking, if we start with investment banking first, let's begin and write some points related to this and see what is there inside this. Investment banking is that area of banking which assists in creation of the financial fin capital for its clients and for the institutions, companies, governments, or other entity. Basically, investment banking is about providing an exchange of money, and you can say, and making it available to those who are in need of money for financing or expanding their business from those who have excess capital and are looking at means for lucrative investment options. So now let's see what is there exactly in investment banking. We'll see in a chart and let's understand that. See over here, investment banking includes the research portion, that is the equity research, forex research, bond research. So many of those things are involved over here, where they make the analysis of the price that they should pay. Here there is a sales and trading of derivatives, bonds, forex. So those are part of the main operational banking branch. So over here the sales and trading is done. Raising of capital includes your initial public offer, follow-on public offer, rights issue, QIP, qualified institutional placement, splits, reverse splits. So all those of raising of capital is included over here. This was as a part of the equity. As a part of the debt, there is as a part of the equity, it is called equity capital market. As a part of debt, it is called debt capital market. So the debt capital market basically includes in issuance of debentures, bonds, etc. Over here, the mergers and acquisitions takes place, spin-off, split-off, divestitures, equity carve-outs, and so on and so forth are included in mergers and acquisitions. Then there is restructuring and reorganization, like corporate debt restructuring. There is strategic debt restructuring and financial and business restructuring, which are the part of the same. So the first and the foremost thing, an investment bank, they basically acts as an underwriting agent. Okay, they are basically known as the underwriters, and you can say that they raise capital via the debt or equity. As I told you, equity capital market and debt capital market involved in other IPO management activities like consultation, book building process, framing of companies, memorandum of understanding, and offer letter, along with looking after the legal aspects of an IPO. See, the investment banking division, which is known as the IBD over here, the IBD, the investment banking division of the bank, also finds clients for the public. Okay, and the issue for mutual funds, for insurance companies, pension funds. So it also assist for mergers and acquisition, that is M&A, by providing all the kinds of, you can say, additional services to its clients, including security research, market making, and trading of equities, derivatives, fixed income securities, commodities, and currencies, which is included in our sales and trading part and equity research part, which we just saw in that chart. See, an investment bank's activity can be further be classified as one can be called as the buy side. The another one can be called as the sell side. Okay, so the buy side, as the name suggests, provides the buying advice to its clients, which is like mutual funds, hedge funds, and unit trust, life insurance company, private equity funds, and so on and so forth. And the sell side, on the other hand, involves trading of securities for cash and other securities by facilitating transactions or market making, along with raising of capital through underwriters and research activities. Since both the areas of functioning are conflicting in nature, you can say it is essential that the information does not cross from one side of the to the other to another. Hence, an information barrier is created within an investment bank. Always remember one thing: there will be a barrier over there, and and it has been safeguarded to avoid any conflict of interest that may develop in future. Let's see what is there inside the asset management case. Let's see asset management. So in case of asset management, asset management is, in the simplest form, can be defined as the business of handling others' money. Asset management and investment management firms are typically financial services company that invest their clients' money into securities. They invest in equities, they invest in commodities, they invest in derivatives, and so on and so forth. So there are various in currencies also. So these are the products in which they invest. Financial asset management firms employ professionals who are expert at handling other people's money. It involves managing money and handling investments of clients. You can say different clients have different requirements of absolutely, they have different requirements, and a good asset manager looks into particular needs of the clients and recommends the investment products based on the asset allocation to the client. See, it is an exhaustive field that involves planning, recommending, reviewing investments of the clients, be it individual or companies. Handling money is a very tricky job to require, so you to be on a very toes always. The basic aim of any asset manager is to invest their money to the avenues and with minimum risk and maximum return. A wealthy individual does not have time and inclination to manage his investment. So you can say that's where the asset management comes into picture. An asset manager has the expertise into that arena and earning more returns for them, thus enhancing the overall portfolio. The asset management firms, also referred to as in the investment management firms, you can say the investment they are known as investment management firms. They employ professionals who have analytical skills and are able to assess which investment products will be beneficial for them, for their clients, or to us to achieve the desired financial objective within the specified guidelines. The product in which the professional invest clients' money are mutual funds, hedge funds, pension funds, retirement funds, and so on and so forth.
All right, guys. So we're gonna stop it right there, and I'm gonna just go over a few things so we can get an idea of who is who and what is what. And the reason why I wanted to put this video about up because we need to get an idea of what is investment banking versus asset management. And a lot of people do not deal with the aspects of investment banking. We deal with assets management because, as he stated, it's a more easier way to enter the market, where you'll have people basically investing in packets such as derivatives, equity, and other programs under their mutual fund package. So they'll look at what you have, what's your assets, and then help you manage it in these different tools and different economical growth sectors that they have, which comes through the investment banker. The investment banker is not a lot of us out there. It's not a lot of us, and it's not a lot of people who consider themselves investment bankers. They deal with financial capital, so they deal with money exchange, exchanging money. So that's what we deal with when we're dealing with exchanging our fiat money for gold. So in a way, you're kind of investment bankers. But what that goes to say, that's what investment bankers deals with, exchanging money. They play positions as underwriters for your loans. So that's who you're dealing with. These people are structurized in laws and trades and economics, and they understand bonds, EFTs, and basically what would be risky for the company. So, and they deal with a lot of buying and selling. And as he said, what that goes to say, a few weeks ago I was out marketing, and it was a young lady who was talking about, she's an investment banker, and she teach people about how to invest in the asset, and how her license doesn't allow her to work on one side of the business. She only can work on a certain aspect, so it won't be a conflict of interest. So what that goes to say, there's a buying and a selling side to being an investment banker, but you can be an investment banker for your own self, because once you understand the stock market and you feel like that's something that you want to do, and you're able to enter these markets without having to use, like day trader or things like that, and you have the capital to go in as a private person, then that is a different way that you can enter the investment banking sector without having to go through the asset management side of it. Now, the reason why I wanted to distinguish the two, because we deal with a lot of asset management. And when I talk about the Franklin template college savings that I have for my kids, that is asset management. So when I called and I wanted to talk to them, like, hey, okay, so I want to choose where my money go into. So what specifically stock is it going into? Or I'm investing. You can kind of choose a general area, maybe environment or something like that, but I don't remember how it's broken down right now. But later on weeks we're gonna go, because I remember talking to this young lady, and she was like, well, you can't pick specifically what you want to invest in, because I wanted to see would they allow me to invest in gold through them, or minerals and things like that, directly through Pacific companies. So we can't be privileged to that information when you're dealing with an asset management company. Okay, so the reason why I played that, I hope y'all understood him. You can look this up on YouTube. Wall Street Mojo. He is a teacher, and what that goes to say, he is from another country. So if people don't understand the accent, then just don't watch that video. But he gives a lot of good information. We're gonna move on to the next section. The next video. The next video is what is asset management. So I broke down what is asset management to you in in terms, but we're going to let this video break it down to you a little bit more. Because, it's always good to learn from a diverse set of commentary that allow you to expand your horizons.
Let's get back to the real asset management world, where jobs can be split into three main functions: investment and research, support functions, and sales and marketing. In research and investments, economists and strategists analyse the macro environment, looking at interest rates, inflation, and GDP forecasts. Research analysts look at specific asset classes. For example, credit research will review the credit quality and outlook for corporate debt, whereas equity analysts will look at the prospects for growth or the intrinsic value of a company versus its share price. The fund managers then take this information and construct a portfolio based on the requirements provided to them. This will involve an assessment of the relative value of sectors and the most appropriate securities for their portfolios. Once the fund manager has decided which securities should be bought or sold, the orders are passed onto the order execution platform. Then, the dealers or traders review pricing and liquidity in the market with the aim of buying or selling the asset at the best price. In support functions, legal experts and compliance officers help the company, its clients, and its business counterparties to keep their activities legal and compliant with regulations or policies. Also, they monitor regulatory changes to ensure that the company adapts accordingly and maintains its reputation. The press and communication team develop the image of the company by publishing relevant press releases and promoting corporate social responsibility activities. Risk managers help the company to identify, measure, and anticipate underlying risks by conducting quantitative and qualitative analysis. Technology specialists construct and maintain the IT systems to ensure different business lines run smoothly. They also manage enormous amounts of data and keep the information safe. Operations specialists like portfolio controllers check the valuation of the instruments within the funds, while the middle and back office functions ensure that orders are correctly booked and settled. In the sales and marketing departments, the sales specialists keep close contact with clients, listening to their needs and selecting investment solutions that fit their preferences. The marketing specialists develop strategic marketing plans to present the company, the expertise, and its solutions. Marketing campaigns facilitate the work of sales specialists. In addition, the RFP managers reply to detailed questionnaires from prospective institutional clients.
All right, so we just going to highlight a few things she said.
The RFP manager.
Okay, so when you have an asset management company managing your assets, this is all it's supposed to entail when it comes to picking the right type of investment tool that you're going to use or your money be attached to, which is such as bonds, EFTs, debts, as well as EFTs are connected to debts, as we talked about, and they're compiled together and they resold to the next person from the loan companies or the next investor. And if those are strong, like they said, they have people in the market, economic strategists, to pay attention to what's not only going on outside in the economy as far as the interest rates, as the things that we talked about, the GOPD, or the human development scale as well. This is the whole environmental factor that they look at when they are interested in putting the portfolio together to sell to people like me and you to invest in via mutual funds. Okay, so they have research analysts, fund managers, dealers, as well as people who deal in the legal compliance to make sure that they are within the boundaries of I think it's the Federal Trade Commission and the rules and regulations that's set upon for them. So this is the basic structure of and the main function of what asset management companies supposed to do. And with all that goes to say, that is a nice big team. We should be making some money. I'm just saying. I already told you from the beginning I was a little tight. And I was like, you know what? This is a good topic to talk about because after years and years of investing and putting your money or saving your money in a mutual fund, and especially if you're a private investor, you're not, whatever you're invested in, like a 401k is something, is a different investment too, but that can be matched sometimes by your employee. But if you're a business owner putting your own money into, mutual funds and other asset management tools, you want to see some yield from it. So let's move on to our next video. And the next video is going to be Mutual Funds Simplified Asset Management Company. Okay. So again, this is going to go over some of the things that we just went over, but it's going to simplify it a little bit more.
Is that how you're passing your time today, Sumera?
Yeah, but I'm kind of stuck now.
Okay, it's my turn now. AMC.
Oh, not bad. So I was just trying to creatively kill some time, but I think AMC is what you're always thinking about.
Right. Well, asset management company is the place where the fund house decides when, how much money gets invested of the money which is pooled from individual investors.
Wow, so I don't envy the job of a fund manager. You have to manage this entire pool of assets and then you have to decide where to put that money.
Correct. The objective, in fact, the main objective is to make sharp, lucrative investments to maximize return for investors, keeping risk in mind.
Well, maximizing returns and managing investors' money, that's a big responsibility. But Firoz, I've always been curious to find out what actually goes on inside an AMC. How are things actually done?
Just like when you buy this puzzle, you get a board to play on, you get 100 letters, you told that 2 to 4 players can play. Similarly, every mutual fund comes with an objective and a theme pre-decided. And the fund manager, when he takes decision, he does thorough research before making any financial decision and also makes sure that the team is on the same page.
All right, so that makes sense. So if I have to select a fund, I look at the fund attributes, I'd look at the credentials of the fund manager. Besides these very obvious ones, what else should investors look out for?
The team size, the number of analysts it has, how many years of fund management experience does the asset management company have, what are the total assets it manages, and the fee structure. All this put together becomes my input to take a decision.
But Firoz, there is always this misconception that AMCs are not as reliable as banks, especially in the minds of retail investors. I mean, they do come under the purview of SEBI, Reserve Bank, Finance Ministry, but not everyone is aware of how tightly regulated AMCs are.
Sumera, of course they're very credible. We've spent years and decades of the asset management company or the mutual fund companies in India. They're regulated by SEBI. There's a checker and maker concept. There is a registrar. There's a custodian. It is a trust format which gets created. So I personally think that it is a very safe platform.
Well, there's no doubt about that. So there are no loopholes. AMCs are about as good as they come. It's a good place for you to park your money and let compounding work for you. Well, Firoz, thanks very much for...
Okay, guys, so I wanted you to get another breakdown. He simplified it in a way where it'll help you make some good decisions in regards to choosing an asset management company. This video was made by CNBC TV 18. So if you want to look at the video again, you can look at the video. But one of the things that he highlighted is to know about the company, to know about the management of the company, how long the company has been working, and how successful the company has been. So, I was doing my little research on Franklin template, and to find out that they are under a trust that is connected to the Roth. So we're going to just leave that alone because we already talked about who owns the world. So I was like, oh, so I'm actually having my money pooled together with other people's money, and we're just giving it to the Roth Trust to invest on what they want to invest in these investment tools that is created by investment bankers that supposedly analyze the economy, analyze the market, analyze what's going on with the businesses, analyze how the business is structured and the possible outcome, and what market is successful based on those things. Right. So why haven't I got any extra money? Okay, so if anybody else have different experience with their college savings for their kids, and they're seeing more money coming in, where it comes to interest and dividends, then let me know, because I've been dealing with them for a little while and I'm not seeing anything. So it's basically like I'm just paying them to hold my money in fees, when I can take that money and invest it in something that I know is going to actually bring me some type of interest back or something. So we'll talk about that later on a later term. So we're supposed to have a diverse portfolio. So if you're going to invest in one thing, it's good to try to invest in another thing. Sometimes you have to take risks, but if the risk is not outweighs the benefit, then you have to kind of like hold up. I have a separatist type of personality. People know me, that if it don't fly right, I don't have nothing to do with it. Some things just not right, and I don't think that you have to be of it or be with it if it's not functioning properly or it doesn't give you what you need out of it. So certain sectors, certain people, certain things I don't touch, I don't deal with. So stock market investment, that's something that we're going to go over later on in the weeks. I have dipped and dabbed in it, but I'm not an expert, and I can't really give investment information on that. But what I can give you is the foundational information and how to understand the stock market and understand what questions that you want to ask, that you should be able to ask your investment banker or the person that is over your asset management company or your portfolio in the asset management company. But you'll probably have the same thing that I have dealing with that asset management company, in which they couldn't really break down exactly where my money was being pooled, like given to, because guess what, everything's pooled together, as well as I did choose a certain what do you call it, class to invest in, but that class as well as invest with other people, and it doesn't seem like it's going too well. I think that they are getting fees from me. That's all I'm saying. So I'm gonna stop talking about my mutual fund, and we're gonna talk more about learning about what is a mutual fund now. Okay.
Now, before anything else, if you have no idea
there's a big government scandal going on that you need to know.
what the stock market is, how the stock market works, then definitely go and watch the videos that you can see down in the, if you're watching this on YouTube, in the description box. If you're on my site, just down below the video, I've linked a couple videos that I've done that explain, what the stock market is and how it works. So watch those first, because I'm actually going to carry over an analogy from those videos about pizzas to explain how mutual funds actually work. So with that being said, I'm going to, from this point forward, assume that you know how the stock market works. And the way a mutual fund works is you have people out there. So you have all these people, could be you, could be your parents, could be, your friend next door, it could be anybody. And these people are just, they want to be hands off. I mean, yeah, I want to get involved in the markets, but I don't really want to necessarily do it myself, as in, go and buy stock for myself, or just, I just want to be hands off. And that's probably, I'm making up this statistic, but that's probably 95% of the population. Most people, I'm going to give it to a financial advisor, I'm going to give it to a financial planner, a stockbroker, whatever, but they're going to give their money to somebody else because they don't really want to be hands-on. So that's really the first step where a mutual fund comes into play, is it's going to be geared towards people that are hands-off. So what are these people going to do? Well, these people ideally have money, but like I was saying, They just don't want to manage it. They don't want to do it themselves. Or they don't want to do it themselves in terms of, having to put in all the time and effort that really goes into it. So what are they going to do? Well, kind of two routes they can go, but they're going to give it either to a financial planner. So this is one way. You could have the financial planner up there. Let me change this to green, just to illustrate this is kind of a money guy. And then this guy can go and do this, or they can actually do it themselves. So there's really one of two ways. But when I say do it themselves, you may, what do you say? You just said these people want to be hands off. Well, that's essentially what a mutual fund allows you to do is be hands off with a little bit of hands on. Now, if you want to be totally hands off, then yeah, they're going to give it to there. But really, if you just put in a little bit of effort, you can cut out this middleman, save yourself some fees, and it kind of works out better. But point being, this is not like a strategy video. It's just what is a mutual fund. So either way, you can either be doing this or a financial advisor can be doing it. And what a mutual fund is it just a big old box. Maybe you've heard it before. If not, maybe you'll hear it at some point. It's like a mutual fund is a basket of stocks, meaning there's a bunch of stocks that are within it. But going back to the pizza analogy that I used in what is a stock market, we're going to call it a box, and inside of this box is a pizza. If you get a pizza like that from the store, demand your money back. That is not a very good circular pizza. But anyways, so you have a pizza inside this box. Now, the special thing about this pizza is how it's actually divided up. Because in the stock market video, remember, a company is just a pizza, and then a pizza can be divided up into many pieces, and then those pieces are sold off so that company can raise money. But in those cases, they're all going to be the same type of pizza, right? Let's just say a company is pepperoni. Every single slice is going to be pepperoni because that is their company. Another company may be just, sausage. So their whole pizza is going to be sausage because that's what their company is. But with a mutual fund, you're getting all kinds of different pieces. So yeah, there's a pizza in the box. The box is known as a mutual fund. But then within that, right here, maybe you have a slice of pepperoni. And then over here, well, that color won't work. You have a slice, and we'll just call it, a cheese pizza, just good old-fashioned cheese. Then right here, that's the worst. That's supposed to be a fish. Maybe right here you have some anchovies. All right, so you have a slice of pizza with anchovies on it, and then so on and so forth. You have all these different slices. And all these, X, Y, Z, I ran out of letters, so we'll go back to A. You have all these other different types of pizzas. Yeah, it is a pizza, but the way a mutual fund works is it's putting many slices, many different types of companies into one single asset group known as the fund. A fund is just made up of a bunch of slices of pizza. But in lingo, a mutual fund is an instrument. Instrument is the same as, basically picture the instrument as the box where money managers are picking out companies all over the place, all different ones. So Apple, Facebook, GE, Ford, PF Pfizer, all these companies, and then they're putting them into one fund. So what's the point of this? Well, the point of all this has to do with one word, and that word is just, you want to be diversified. And that's what a mutual fund is allowing you to do. Now, there's many types of mutual funds out there. They all have different goals and ways that they're diversifying, and that's what they will be explained when you read more about them. But that at its core is what a mutual fund is doing. It is a very simplistic way to diversify your money within the stock market itself by only buying one thing. So you buy one mutual fund and you're diversified in a pretty big way, depending on what that mutual fund is actually doing. So as far as all the nooks and crannies, there's different types of commissions and fee structures for mutual funds. I'm not going to get into all that, but if you do decide that you want to be one of these people that, I want to be a little hands-on, just realize that there are a couple of different fee structures. Maybe I'll do like an advanced mutual funds video at some point where I explain the different types of fee structures. But at its core, that's what a mutual fund is. It's a way to take a whole bunch of stocks that are out there and package them in one box. One basket, one instrument, if you will, or the fund. Put them all into one fund, and that is how diversity is accomplished, and it's just a really quick way for the investor to be able to get involved in a whole bunch of stocks by only buying one thing. I mean, if I want to just go out there and, technically build my own mutual fund, well, then I have to personally go buy Apple. Then I'd have to go and buy Facebook. Then I'd have to go and buy, GE. Then I'd have to go and buy Ford. Then I'd have to go and buy, Coca-Cola. And in the process of doing that, yeah, I am technically creating my own mutual fund because I'm diversifying. But if you're thinking, I don't want to do all that, you just had to go buy all these different stocks. I want to buy one thing. That's what a mutual fund is. And, back to the pizza analogy, it's a box. Within the box is a pizza. However, the pizza is divided up with a whole bunch of different slices. If you are out there trading alone currently and maybe are in the market.
Okay, so this is the gentleman name is Clay Trade. You can find him on Instagram as well as YouTube and Facebook. And let's just share his information if you are interested in seeing him again. Clay Trader 25 Facebook and Clay Trader on Instagram. So what this goes to say, now you understand what's the difference between a mutual fund as well as what's like an individual investor. Like, oh, you can consider yourself an investment banker. So what basically that company is doing is, like he said, they created, he didn't say it, but what the mutual fund company do is create a trust, and under that trust they hold all of these different dividends from these companies, and you invest in these companies and they put it in one pie and one portfolio, and then you and all the other people are shareholders or beneficiaries to that specific trust. So now if you understand trust a little bit, because I have shared a few videos about trust on the Black Discovery channel as well as Secure Your Energy. I think y'all need to go there and find out what a trust is and how you can utilize a trust to make your assets private as well as have it in a different tax bracket. That is some good information. So I am sharing that because you can actually, like he said, you can go to different companies and invest in these companies, supposedly Apple, Facebook, and you make your own supposed diverse portfolio mutual fund, but you take all of those assets or those stocks and you put it under a trust, and within that trust then those assets are protected under a different tax bracket as well as not considered attached to yourself as a U.S. citizen, but it will be attached to that entity, which is a trust, and you still have to follow trust laws, regulations, as well as the IRS does deal with trust, and you do have to pay some taxes on certain assets of trust depending on how much money it is. So trust is something that we'll talk about later on down the line, but I do have a few videos about it. We're going to go more deeper on later on. Let's move on. Because you could be your own investment banker, baby. You don't need no investment company. Because you be seeing me. Either you're going to be the guy that let the third party do it and you pay them fees. Or you're going to be the person that just do it yourself and create your own entity that you can house your investments and protect it for the future. And then you can always sell it, keep, and know exactly what you're dealing with. So that's why I wanted to share this with you, and so you can know the difference. Because people are like, I got me a 401k and I got this, but you don't know what they are actually connected to. So you don't know how well they will do. And this is how individuals lost their 401k. This is how their 401k wasn't able to be matched when the 2008 crisis happened. Okay, and if you are on my Facebook page, y'all know I went to Living Wealthy seminar, and there I met a whole family that went through the 2008 housing crisis as well as lost a lot of money. It was a doctor, one was a dentist, the lady was a doctor, the husband was a dentist or something, don't quote me, son. They all basically started their own business right after this happened because they lost everything. And as they stated, it was no way for them to build their assets back up that fast at an age that they were at. They were already in their 40s and 50s. Their kids was 15, 16, 9, and another age. Okay, so this is why we share this information. This is why we talk about this information, because we have to be diversified in our portfolio and make the decisions we need to make for ourselves. So let's watch the next video, which is how does a mutual fund work. So it did explain to you, he did explain to you how the mutual fund work. I can't share that video, but I think that y'all got a good idea. I always try to have more and more information simplify it in a matter that we all can understand it and we all can build it, construct it into our own comprehension and utilize it for our development. So we're going to move on to the next video, which is
space and space for women? Who wrote that? Are people really still asking that question?
Operation Make Space.
Give it a second to upload, guys, so to catch up.
With a metal 3D printer. Introducing the Metal X, the easiest way.
Starting off this hour is California. Chad is calling. Hi, Chad. How are you?
Good. How you doing, Dave?
Better than I deserve, sir. How can I help?
I had a question about mutual funds. I'm just starting to do the investing part, and I went to a broker, and I'm finding some good mutual funds with the good percentages, like you say, with the front-end load fee being about 5%.
5 and 3/4 is what most of them are. Yeah.
Yeah. I was just wondering if that's the 5, whatever you said, the 5 3/4%. Is that when you say it's a 12% return? Would that mean that I'm really only getting 7%?
Well, it's not 5 3/4 a year. It's 5 3/4 the first time you put money in.
Okay, see, I don't know everything, and I was
okay. That's okay. Well, let's talk through it. There's basically 3 ways you can get at this. Okay. There's what are called loaded mutual funds, which are mutual funds that have a commission, and there's no-load mutual funds that don't have a commission. There's 2 types of ways to get at the loaded funds. Let's talk through it for a minute. We'll use you as a teaching opportunity for all our listeners. Is that okay?
Okay.
Yeah. And then you just walk through me with this, and you got any questions, you interrupt me as I go, okay? To start with, a no-load fund is not sold through a broker. You buy them directly from a company, and you'll see their advertisements in magazines and on websites and things. It's companies like Vanguard and Fidelity, okay? And they are primarily no-load, which means they don't charge a commission. Now, no commission does not always mean cheaper for 2 reasons. One is there's 2 or 3 ways they charge fees on mutual funds. All mutual funds have a maintenance fee annually, okay?
Okay.
Based on your balance at that time. So let's say you had $100,000 in there, and the maintenance fee was 0.75%. That'd be $750 that you were charged as a fee for maintaining the mutual fund. Okay? Now, a no-load mutual fund has a maintenance fee. So you're still going to have a fee. It just doesn't have a commission, doesn't have the 5 3/4 or the other kinds of commissions we're going to talk about in a few minutes. So you do have a fee. Now, let's say that let's go back to our 5 3/4 example. Okay? Let's say that you put $100,000 into that fund with that broker, and you paid the commission of 5 3/4. Well, that'd be $5,750, right?
Yeah.
That you paid up front. Now, then your maintenance fee on that fund, let's say it was 0.25%, only $250 a year. So for 10 years, that'd be $2,500. After 10 years, you would have paid in maintenance fees. $250 a year times 10. Do you follow that?
Yeah.
Okay. And then you'd have paid the $5,700 on top of that. And so we're talking about $7,000 and some change over $10,000. You following me?
Yeah. Okay.
Over 10 years. Now, the other one, let's pretend it had I looked at one the other day that was a no-load that I didn't buy because it was a ripoff, I thought. But it had over a 1% maintenance fee. It had a 1.2% maintenance fee. Okay, so $1,200 a year, right?
Yeah.
For 10 years on $100,000, that's $12,000.
Wow.
Okay, so you paid the commission on the other one, but it was cheaper. Do you follow me?
Yeah, that's what in my mind I thought. If I could go around the broker, I'm going to make a lot more money. But
not if you get one with a high maintenance fee.
Yeah.
So you gotta watch. They get you on the back if they don't get you on the front. Now there are good no load funds that have reasonable maintenance fees, and sometimes I buy a no load fund. Okay, I'm not against them. I'm just warning you that no commission does not always mean cheaper. You have to dig a little deeper to figure that out. Okay.
Yeah.
So that's the first thing. Then the second thing is, with commissions, there's basically two ways that people are charging now. One is they're doing the 5 3/4 up front, like you're talking about, which are A shares, okay? And the second way is that they're doing what are called C shares, and the brokers will manage your whole portfolio for you. Instead of charging you a commission up front, they'll do it for 1% a year. Okay? Which is not a bad deal, because you got a broker there to advise you and teach you and help you for every year. If you got a good broker that's involved, and you can call them, you see a bad news story about something and you're worried about the stock market dropping 400 points last week in one day, and you want to call your broker, you got somebody to talk to. And there's actually research, Chad, that shows that if you have a good broker in your corner, you tend to make more, because you tend to not make as emotional a decision.
Okay, that makes sense right there. I guess that's worth it.
Yeah, it's worth it to have a coach. There's research that indicates that, lots of it, as a matter of fact. So you could do the 1% deal, where they just charge you 1% a year and there's no commission, but they charge you a 1% fee to manage everything, but they're there at your beck and call if you need them, and if you want to put more money in, there's no fee, except the next year you're going to get a 1% bill on that money that you put in, on top of everything else you put in. But Again, some people love that, and they act like that the people that charge 5 3. Some of these people have a holier than thou thing in the financial world, and they act like the people charging 5 3/4 are ripping somebody off. But let's do the math again, because these are the exact same two mutual funds, just two different ways of charging a commission: 1% to manage it, or 5 3/4 up front. So let's take our 100,000 again. 5 3/4 is $5,750. Okay, 1% on 100,000 if it doesn't grow at all, which would be bad, really bad. But if it doesn't grow at all, 1% is $1,000 a year for 10 years is $10,000. So even if you do the 1% with, quote, no commission, you pay more.
Okay, so it's better to do the A shares.
Yeah, as long as you leave it alone. But if you want to buy and sell the funds inside of there, and you want to move some stuff around later on, you're going to pay that stinking 5 3/4 every time you move it around. So the truth is that all three of those work. And I'm okay if you do any of the three, as long as you look at them carefully for your situation and you decide. I used to be a huge proponent only of the 5 3/4 up front because of what we just did, but the 1% thing is fine. And the no load is fine. But you're not wholly, if some of these guys in the financial world are Pharisees, and they're like, oh, I'm a 1% guy, and so these other guys are ripping people off with a commission up front. And then the people who don't want anybody to ever be charged a commission are saying anybody who charges a commission are ripping people off. It's just not mathematically true,
Okay. So yeah, I read some of that online.
All right, so that was a great video. What should I know when buying mutual funds? I like this guy. He's very mutual. He's an economist to me. The Dave Ramsey Show. You can like and subscribe to his channel. Okay, he has some great commentary. So some of the key things he said, just to break down the different ways that you can invest in these mutual fund companies, as well as you don't have to use these mutual fund companies. You can actually find a broker and then create your own portfolio. So there's different fees that come to the broker, and as he mentioned, the standard right now for brokers is probably 1% maintenance fee, and then you may have to pay like entry fee, 5%, 5.2% on that. And anytime you trade, you'll have to pay 5.2%. And then at the end of the year, whatever money you make, you give your broker 1% of that. So if that works for people, that works. The other option is to have the 5.2% on the front end. You have no broker, and with that you pay commission. You pay no commission on that, but you have a portfolio that you can't change and day trade or trade when you want to, or have any type of control. You're basically basically kind of like just the outside person going in, like I said, a pool of you guys are investing in a pool of businesses. Okay, so that's the difference. So if people want to be more hands-on and be more in control of their assets and their tools that they're investing their money in, you can go through a broker. You can find a reasonable broker that's going to help educate you and bring you to that level. That's for the person who really likes to go that route and understand where their money going to. But if you want to continue to use the mutual fund, that's the more laid back way, where you'll be kind of like the third party with the maintenance fees, and you have it in like a diversified account portfolio, but you really don't have any control over it. So as I say, with my mutual fund, I have been putting money into it, and it's supposedly in a diversified portfolio, but with the fees and with the market supposedly not moving, I'm not reaping any benefit of it, and this college savings is just sitting there. At the end of the day, I'm just paying for maintenance fees. I don't know if other people have other things going on, but I want you to share your comment behind anywhere that I leave this video. If you feel that you have a different experience with your mutual fund company, share it with us, because I want to look into it. I need to find the best college saving plan that I can have. But at the end of the day, when you take money out of it, you get fined. You don't got to pay it back, but you do have to pay a fee on it, and then you have to tell the tax person, So when you take your money in out of your savings account or out under your mattress, you ain't got to tell nobody. But that's just my ad lib. Mutual funds distribution explained. It's like a short 3-minute video. We're gonna get through that, and then we're gonna move on to get a little bit more details into the college savings, specifically college savings plans.
One of the trickier things to understand about investing in mutual funds specifically are distributions, how they work, what they mean to you, the investor. So today we're going to tackle that slightly more technical topic. Mutual fund distributions are payments to you, the investor, for any income that the fund has generated throughout the year. They can be interest, they can be dividends, they can be capital gains. Sometimes they're paid out quarterly, often they're paid out annually. Your unit price is going to drop by the amount of the distribution, because the distribution, again, is a payment to you for money that's been reinvested in the fund throughout the year, for example. Okay? So your unit price drops by the amount of the distribution. If it was $10, then on the day of the distribution, it's going to drop by, if the distribution was 10 cents, it'll drop by exactly 10 cents. The new unit price will be $9.90, provided there's been no market movement that day. The number of units you own is going to increase, because when you're paid the distribution, it's used to buy you additional units of your fund at the new lower price. The adjusted cost base is really important to understand, so let's kind of define it first. The adjusted cost base, or ACB, is essentially the average unit price that you've paid over the lifetime that you've owned that investment. So over time, you might buy at $8 a unit when you start. Say the market goes up, your next purchase is at $8.50. The market goes up more, your next purchase is at $9. The market goes down, your next purchase is at $8.75. Essentially, depending on how much you're buying, you're getting an average price there, and that is your adjusted cost base. Now, when you're paid a distribution, your adjusted cost base will decrease a little bit as well, because the income you're receiving is being used to buy you additional units at a lower price. Therefore, it's going to reduce your ACB. Distributions are taxable in non-registered or taxable accounts. They are not taxable in RSPs, TFSAs, or RIFs, so basically any registered accounts. You receive a T3, or in some cases a T5 tax slip, which is going to tell you the combination of potentially interest, dividends, capital gains, or return of capital that your distribution has paid you. So the interesting thing about distributions is it actually doesn't affect the dollar value of your investment. So if your account was worth $1,000 yesterday, and then the distribution was paid at the end of the day, today it's still going to be worth $1,000. The difference is you're probably going to have a few more units, because your distribution was used to buy you additional units of the fund at that lower price. So mutual funds often act like a person. So here's what I mean. As a person, you might have a savings account, and throughout the year, you might earn some interest in that savings account. The thing is, you don't actually have to pay tax on that interest until you get your tax slip and then you file your tax return, right? Mutual funds work the same way. So the things that they buy, the securities they own, generate income throughout the year, but there's no tax on it. At the end of the year, they distribute that back to you and me, the unit holder, and then we have to pay tax on it when we file our tax returns.
Okay, guys, so that was a great breakdown of mutual funds, and you can see we're gonna go into college savings because there's a little difference between college savings and mutual funds, but they kind of work the same way. They just were used for different purposes. You're supposed to take the college savings out for specifically college use, books, academic development, and the mutual funds is a separate investment tool that you usually will have a time where you have quarterly payouts, like you said, or annual payouts.
Is there enough space in space?
Based on your investment and the time frame that's set up with that mutual fund company. All right, so let's go into college savings plan, pros and cons. Hold on. Sorry. We're going into 529 college savings because that's the other way of saying it. When you see 529s, know it's a college savings. 529 college savings. They probably got different trust holding companies like Franklin Templates, because I'm always calling Franklin Thompson. Franklin Templates, that's the trust holding company. But at the end of the day, it's a 529 college saving plan. Okay? And that's what I've been complaining about because I'm not seeing anything. So that's what I'm complaining about. That's the type of tool that I'm complaining about. Mutual funds is a little bit different, but we have to kind of I want you to get an idea of how they're similar. So 529 college saving plans, info, advantage, disadvantages, and rules. Okay, there's always some damn rules, and they tax rules. They just make us pay some taxes. I'm just going to be quiet.
In one of our previous videos, we discussed about the basics of college planning. In this video, we will take a look at the 529 plans in detail. We will try to address such questions as what is a 529 plan, types of 529 plans, what are advantages and disadvantages, restrictions, and so on. I will not be selling anything in this video. The details presented are strictly for informational purpose. For this reason, I kindly ask everyone to support our mission by liking, sharing, and subscribing to our channel, Let's Talk Money. So let's get started and explore what is a 529 plan. A 529 plan is established by a state or school so that you can either prepay or save up to pay education-related expenses. A 529 plan is formally known as Qualified Tuition Program, as defined in Section 529 of the Internal Revenue Code, and are administered by state agencies and organizations. Savings in a 529 plan grow free from federal income tax, and withdrawals remain tax-free when used for qualified higher education expenses. Additionally, many states mirror the federal 529 plan tax advantages by offering state tax-deferred growth and tax-free withdrawals for qualified higher education expenses. Each state that offers a 529 plan determines how its plan is structured and which investments options are offered. While many plans allow investors from out of state, there could be significant state advantages and other benefits for in-state residents. This can include state tax deductions, matching grants and scholarship opportunities, protection from creditors, and exemption from state financial aid calculations. Now let's take a look at a 529 savings plan from various points of view. We'll start with the maximum investment that is allowed. This is established by the program or the state. Many allow contributions up to $300K per beneficiary, but you would want to check specific rules and limitations in your state. Federal income tax. The contributions are not deductible. Withdrawn earnings are excluded from income to extent of qualified higher education expenses. Federal gift tax treatment. Contributions are treated as completed gifts. At $15,000 annual gift exclusion applies, or up to $75,000 with a 5-year election based on year 2018. Federal estate tax treatment. The value is basically removed from the donor's gross estate. Partial inclusion for death during a 5-year election period applies. And let's take a look at what are considered qualified expenses in a 529 plan. Basically, in order to be qualified expenses, those are considered those paid for tuition, fees, books, computers, and related equipment. Supplies, special needs, and some room and board at eligible colleges and universities also are included as qualified expenses. Also, up to $10,000 in tuition expenses at private, public, and religious K-12 schools are also considered qualified expenses. Let's take a look if you can change the beneficiary in a 529 plan to another member of the beneficiary's family. In other words, this plan allows the change of beneficiary, and the funds could be used for another qualified individual in the family if the beneficiary decided not to go to college or for any other reason. Let's take a look at the time and age restrictions. There are no time and restrictions unless specifically imposed by the program. And let's take a look at the income restrictions as well. There is no income restrictions that I was able to find while doing research. Another very important aspect of 529 plan is the federal financial aid. The resources in a 529 plan are counted as asset of parent if the owner is parent or dependent student. Investments. There are various diversified investment options available based on your comfort with risk, but there are restrictions, so you might want to take a closer look at the diversification.
All right, guys. So I just want to go over a few things. I know she's talking a little low, but she said a few key information about the 529 college saving plans. One of the things that this name came from was actually a section in the IRS code, which allows this specific account, bank account like investment account, to have or to be used for write-off purposes. It's supposed to be tax-free money when it's inside of the account, but you do pay taxes on it if you withdraw the money and don't use it for the school purposes. So in a manner, you do get some benefits from the 529 college saving plan, because it can be a write-off. It can be a write-off, as well as the what they say, it doesn't affect students' financial aid. So, for instance, if you're going for financial aid and you have all this money in a bank account, regular bank account, it's going to be considered an asset of you. Okay, instead of if you had this college saving plan saved for you, it would not be considered an asset if you needed more financial aid, and they won't look at that and it won't affect your grant. So that is the little benefit of it, because if you had the money out in a place where they can actually check the asset in a public account as your public assets, they utilize that to weigh what you qualify for in financial aid. Okay.
Options. Use of non-qualifying expenses. If you use the funds for other reasons than qualified education spending, then withdrawn earnings are subject to a federal tax and 10% penalty. As I mentioned in the beginning of this video, here are a few things to keep in mind in regards to 529 plans. Let's call this disadvantages. High fees. 529 plans often have higher fees than can eat up the growth of this account. So be careful, try to choose plans with lower fees. Limited investment options. This is a typical issue for 529 plans. Indeed, 529 plans offer a more conservative menu of options available, and some don't offer an adequate selection of investments.
Okay, so as I told you, with the college saving plans, you have different packages that you can invest in. So this is what is constructed into: conservative, moderate, or aggressive. And then you get the option to choose which one based on the statistics of what the actual company has been doing in the last few years. So you will receive a booklet so hold on one second, I'm about to show y'all. You receive a booklet, and that booklet will have different rates and percentage of how those actual conservative, moderate plan work over a 5-year plan, 5-year term, 10-year term. So you'll actually start to see which bracket you'll want to put your money in and which one has been effective. So you have to do a little research. That's when you just have to do a little bit of research if this is the investment tool that you want to invest in. But as you said, as you know, I was doing research. I was highlighting all of this stuff. I was highlighting 2 years ago and like, okay, this is the best. And you know, they can't really give you advice. They're like, well, if you want advice, you could talk to a broker. Or did you read the proposal? Because I'm like, which one do you think? And then they're like, nope. So they like, you ain't paying me the brokerage fee. Don't ask me nothing. So they do have a book that will come with the mutual, the college savings plan, as well as the mutual fund or whatever you invest in. If you go through like Prime America and things like that, they send you a booklet of their insurance plan. So you need to know as well. We're going to talk about insurance plans coming through from these companies, you know, and being careful and choosing the right ones for you. Because as you get older, sometimes the premium goes up and your income is not going up. So that's later on broadcast. But let's finish watch this one.
That's why it is important to research plans that will allow parents to build a diversified investment portfolio while keeping in mind the risk and growth potential. Also, financial aid eligibility. Be aware that any investments or savings can affect federal financial aid eligibility of the student. The impact on financial aid varies depending on whether the savings belong to the parent or the child. States and private colleges may have their own rules for financial aid, and some states give more favorable treatment to prepaid tuition plans.
See, I learned something new because I know that the state that I was in, it was considered not an asset, and we were able to offset it. It wouldn't offset on the actual funds that I had myself because I wasn't under parents. But that's good to know because some places actually use it as an asset, so it can be a disadvantage.
And other college savings options. Also, taxes and penalties. While this could be a great tax advantage account in most cases, it can also be a drawback in certain cases. Remember, this is a college savings account. If you use the funds for something else, then you will have to pay taxes on earnings and a 10% penalty. So if you saved money for your child in a 529 plan and the child declared that he or she will use the money to travel the world instead, then you might want to have a serious discussion with your kid and explain all the drawbacks of this decision. After all, this is a 529 plan, especially designed for the education purpose and not something else. Well, that's about it. I will try to post a comparison of various.
Okay, that was a great video from her. So if you want to look at, I'm going to show you her YouTube page. I always like to have diverse, good commentaries. So let's talk money channel. Okay, I think this is the second video that we've seen from that channel. The next one we're going to go into now is, we're down to our last 2 videos because we're going to move on to another subject matter soon. But
right off the bat, 529 plans are a terrible way to save money for college.
Okay, so I'm not gonna put his video up and we watch the whole thing, but I am gonna put it in the group for 529 plans, and the reason why he feels like it's terrible. So he did have some good points in this video that I want to share with people and Secure Your Energy. So if you're part of the group, watch it. You know, I'm just gonna give you the real. I'm gonna give you the good, the bad, and the funky. Okay, so we gonna learn the funky, and he got a story to tell. So the next topic we're going to move into, just so we can branch off of mutual funds, is investment index. Okay? Did anybody ever heard of that? Did you ever hear of investment index as quote unquote, investment funds versus mutual funds? Okay? So let's go into this, and we're going to also bring in the ETFs. Now, we talked about what ETF is, those package debts that they sell to third-party investors. Sometimes they're connected to mortgages, credit cards, and whatever, okay? And you need to know what they are. So let's watch this video together, and then we're going to get down to our last video about Deutsche Bank. If y'all don't know who Deutsche Bank is, y'all going to know today, because I'm going to introduce y'all to them. And then we're going to go, because I know y'all heard Deutsche Bank before in a few videos that I played. They're part of the heavy hitters. They're part of the heavy hitters, okay? They hit hard.
Even the mission.
They one of those, own everything. Run everything, own nothing. How about that? Y'all know what that means.
What's the difference between index funds, mutual funds versus ETFs? Each of these are different but similar investment vehicles with their own pros and cons. We hear these terms get thrown around a lot, and actually a lot of people mix them up, so I know it can be confusing. I actually have a degree in finance, but I didn't even learn this stuff in school. When I invested in ETFs for the first time, I learned later on that ETFs didn't have this one really important feature that I wanted in my investment portfolio, so I had to switch over to index funds, and it was all kind of a hassle. I want to save you this trouble. In this video, I want to share everything I learned with you so that you can be more informed before making any investments of your own. So if you want to learn the difference between index funds, mutual funds, and ETFs, and which option might make the most sense for you, then keep on watching. Before we get started, go ahead and hit that subscribe button. My channel is all about money and investing for beginners, and I know it's gonna help you learn a ton. So make sure to subscribe and hit the notification bell for new videos every week. So let's get right into it. I'm going to start with mutual funds because they've been around the longest. Mutual funds came way before index funds and ETFs. And the earliest known mutual fund was supposedly invented way back in the 1800s. They were created as a way for a bunch of people to pool their money and make investments together. Mutual funds offer three major benefits. The first is convenience. By investing in a mutual fund, you get to own a bunch of different stocks all in one easy package. A mutual fund could have hundreds of different stocks in it, but you only have to make one purchase. In a world without mutual funds, if you wanted to have, say, 100 different stocks in your portfolio, you'd have to make 100 separate purchases, which means you pay trading commissions 100 times, and you'd waste a lot of time sitting in front of the computer clicking the buy button 100 times. So inefficient, right? But by investing via a mutual fund, you get instant ownership in all the stocks the mutual fund already owns. And owning a lot of stocks all at once gives you diversification, which is the second major benefit of mutual funds. Diversification is a strategy that reduces your investing risk by spreading out your eggs. Instead of having all your money in one stock, which is the equivalent of putting all your eggs in one basket, you spread out your money across many different stocks. That way, if one of the stocks in the mutual fund totally crashes, you'll still be fine because each stock is only a small portion of your overall portfolio. Mutual funds typically consist of around 90 stocks at a minimum, so they provide a lot of diversification that would be hard to replicate on your own. The third benefit of mutual funds is that they're managed by investment professionals. So rather than try to find stocks on your own, you have some super smart guy who supposedly knows what he's doing pick the stocks for you. So mutual funds offer convenience, diversification, and access to professional money managers. But that doesn't mean mutual funds are 100% amazing. Convenience and diversification are definitely good benefits, but the problem with having professional fund managers is that they charge a lot of fees. When some really smart, well-educated professional is picking the stocks for your mutual fund, that's called active management. In return for managing your money, Actively managed mutual funds charge an annual fee of 1 to 2% of your account balance every year. So at 2%, if you invested $10,000 in a mutual fund, $200 of that goes straight into the fund manager's pocket. And even if the manager makes poor investment decisions and your account balance actually goes down next year, you still get charged 2%. So you could literally end up with less money than you started with, but the fund manager would still get paid millions of dollars for their services. And even if you find a fund manager who's done really well for a couple of years, their performance usually doesn't last over the long run. And the cost of fees can really add up. Over the years, fees will reduce your nest egg by hundreds of thousands of dollars. So the vast majority of mutual funds are totally not worth the high fees. Then came the index fund. One day, a guy named Jack Bogle got so sick of mutual funds ripping people off that he invented a whole new category of mutual funds called index funds. And index funds totally revolutionized the investing landscape. Unlike traditional mutual funds, index funds are passively managed. This means that rather than paying an expensive fund manager to do active management, the fund follows a fixed formula that totally eliminates the need for someone to make buying and selling decisions. The formula that it follows is based on an index, and that's where the term index fund comes from. An index is a representative sample of the stock market, and indexes were created as a tool to quickly measure stock market performance. Rather than looking up thousands of stocks individually, an index is just one simple thing you can look up to just see how the stock market did that day. If you're not sure what a stock market index is, then make sure to check out this video right here for an in-depth explanation. So Jack Bogle created the first index fund in the 1970s, and it mirrored the S&P 500 index, which is one of the most widely followed indexes in the world. Since the fund simply buys whatever stocks are in the S&P 500 index, the fees are much lower because you're not paying for expensive fund managers to make these decisions for you. The Vanguard S&P 500 Index Fund charges an annual fee of 0.04%, peanuts. So index funds are a type of mutual fund. All index funds are mutual funds, but not all mutual funds are index funds. An index fund will clearly state that it tracks an index, and it will specify which index it tracks. For example, on Vanguard.com, if you look up VFIAX, it says here index fund in the title. So it's pretty obvious that it's an index fund. And if you look at the fund's prospectus, it specifically states the fund employs an indexing investment approach designed to track the performance of the Standard & Poor's 500 index, a widely recognized benchmark of US stock market performance. It doesn't get any more obvious than that. But for a mutual fund that is not an index fund, the prospectus will state something like this. Advisor independently selects and maintains a portfolio of common stocks for the fund. So that's kind of how, in a nutshell, you can distinguish between mutual funds that are index funds and mutual funds that are actively managed and so are not index funds. Moving right along to ETFs, also known as exchange-traded funds. ETFs were introduced about 15 years after the first index fund, and they're very similar to index funds, except for one major difference. With index funds, you can only buy and sell shares once a day. But with ETFs, you can buy and sell your shares whenever the stock market is open. Even though an ETF is not really a stock, you can buy and sell ETFs as if they were a stock. A lot of times you'll hear the terms ETFs and index funds used interchangeably, but they're not the same thing. If you wanted to invest in the S&P 500, you could either go with an S&P 500 index fund, like the Vanguard one that I mentioned earlier, or you can go with an ETF, like the Spider S&P 500 ETF. The question you have to ask yourself is, do I need the 24/7 tradability that an ETF offers, or am I just good with an index fund? In my experience, being able to trade ETFs really doesn't help you achieve long-term investing success, because the fact that it trades like a stock and you can watch it go up and down on a stock chart, it really only encourages impulsive buying and selling. And human nature has a tendency towards gambling-like behavior, which is obviously the opposite of smart investing. So I personally think ETFs do more harm than good. And, why even deal with the added temptation? So if you're not sure whether you should go with ETFs versus index funds, then I would recommend just choosing index funds. They're essentially the same thing, but you won't have the added temptation to gamble with your money. Most people will only have to buy once, hold and then sell when they retire. So you really don't need the 24/7 tradability of an ETF. Another reason why I like index funds, and this is a huge reason actually, and the reason why I switched over from ETFs to index funds, is because index funds offer automatic reinvestment. This makes it really easy for you to save and invest without even lifting a finger. Index funds allow you to set up a recurring monthly deposit from your checking account, and they'll automatically buy more shares for you every month. The best part is that there's no additional charge for doing this. This is a free automatic reinvestment feature, and it makes it a no-brainer for you to automate good investing habits. ETFs do not offer this feature. If you wanted to contribute more to your investments every month, you'd have to buy more shares of the ETF every month, which means more work for you, and of course it means you have to pay trading commissions every time. And who wants to do that? So I hope you have a better understanding now of mutual funds, index funds, ETFs, and what similarities and differences they have. Mutual funds came first, and they offered the benefit of pooled investing. Then index funds came along as a special type of mutual fund with much lower fees and a type of management called passive management. And then finally, the ETF came on the scene, which trades like a stock and offers everything that index funds offer except automatic reinvestment. For more beginner-friendly info on stock investing, make sure you also check out these two videos here. And if you're new to the channel, hit that subscribe button below.
Okay, guys, so I want you to check out Invest with Rose on Instagram. As well, you can go onto her YouTube page. This is all for my beginners, my novel learners, the people who are just getting into understanding economy, stock market, trades, bonds, ETFs. So Invest with Rose is her YouTube page, which is amazing. I'm supposed to be subscribed to her on this one. Okay, so I hope you were able to embody the information that we went over. We're going to go more into index funds, stock market index, as well as S&P index, as well as we're going to go more into ETFs, so we could break that down for us, so we can make sound decisions as investors as well, and see, can we handle these type of investment tools? Okay, because we want to take our energy and our strength in our own hand and utilize it and spread it where we want to spread it with these companies. Also, I want you to look out on the Black Discovery channel, Vanguard. Vanguard is a very popular company. There's a very popular investment firm. So the Black Discovery channel will be doing a documentary on them. I do have some information pertaining to them that I would like to share with everybody. It's very important for you to know who you invest in, because those people that you invest in, they take that money and invest in things that they like. And if they're not on the same wavelength as you, then you may be investing in the devil. All I'm saying, that's just all I'm saying. JP Morgan, don't be mad at me. I didn't say that. I didn't say that. Okay, so we're going to get down to our last video today. Our last video today, we're going to be going into Deutsche Bank. Deutsche Bank has an announcement for you guys. Deutsche Bank is a little bit nervous, okay? It's one of the biggest banks out in the world. Part of the founding fathers and the development of the United States in so many different aspects. If you don't know, go back to the Heavy Hitters video release. They will explain to you how they dealt, how this
Welcome to the future
and
of
other
real estate.
companies played a significant role in mining companies, railroad companies, gun distribution, manufacture, as well as funding the wars. Okay, so let's watch this video together. This is going to be the last one. I don't want to leave y'all with just but we got to be on point, because this financial situation that I've been talking about for the last couple of months did not go away. You can't be distracted, because there's a lot of things going on, such as the impeachment process, that show, as well as rest in peace to Kobe Bryant. In that situation where there's a lot of talk, there's a lot of commentary, there's a lot of news feeds sending love and light to his family. That is an untimely death, but I want y'all to stay focused, because at the end of the day, there's a lot of distractions that's going on systematically, so we don't pay attention and we don't be prepared. Okay, so Deutsche Bank collapse. Prepare for the inanimate economic collapse in 2020. Stock market crash. Okay, so this is not a scare tactic video, but I need y'all to pay attention to what's going on with these big banks. So that's going to be another topic that we're going to go into, Deutsche Bank, as well as we're going to learn a little bit more about JP Morgan. and other heavy hitters. We're going to see, just a little bit of history about them. We're going to try to get it all into one sitting, and it's going to be called the Heavy Hitter Series. We revamped. How about that? Okay, so let's watch this together, and we're going to end our broadcast after this. I thank y'all for being here. I thank y'all for learning, growing, being part of the Secure Your team, looking to innovate your mind and make more mindful decisions when it comes to investment, economy, as well as where you put your energy into. It's very important that you need to know where you put your energy into. It's like we're all working in this manufactured company, but we don't know what the next part to what we're building. We could be building a bomb and don't even know that we're playing a role in this. And this has happened. We ain't gonna talk about that. But that goes to say thank you for being with me today, and we're gonna watch this video
Is the Deutsche Bank going to fail? Why hasn't it failed yet? Year after year, it is the same doom and gloom, but no collapse is happening and no bank is failing. If you are a skeptical viewer, and you should be, then these must have been some of the first thoughts that would have come into your mind after reading the title of this video. Of course, no one can predict exactly when the next big stock market crash is going to hit. It's like a storm. You can see it coming. You can see the dark clouds gathering, layer by layer. You can see them blocking out the sunlight, and when you feel the wind picking up, what do? You do not stand outside to get blown away. No, any sane person would go and take cover to ride out the storm, unless you are a storm chaser anyway. The same analogy holds true for the failure of Deutsche Bank. Back in 2008, did anyone see the failure of Lehman Brothers coming? Probably many people saw that coming, but no one could tell exactly when it would happen. The banks and other financial institutions were busy in painting a rosy picture to the investors right till the moment.
Hi there. Great beds, no bull. That is the original Mattress Factory difference. Quality products plus factory direct pricing equals great value. It all starts with a box spring frame. Original Mattress Factory designs their frames with about 60% more wood. That's a lot more wood.
Right till the moment the markets crashed. So do not be fooled into thinking that just because no one can tell the exact moment of the next big economic crash that it wouldn't happen. The writing is on the wall, and it's only a matter of time. Of course, the more they try to prevent it from crashing, the harder it will be. So let us now look at what all the fuss about this Deutsche Bank is. Founded in 1870 to promote Germany in the growing financial market of Europe, Deutsche Bank was the first step of Germany into international banking. Before Deutsche Bank, German companies were dependent on banks controlled by Britain and France to carry out financial operations overseas, and this meant that German traders were usually at the end of unfavorable terms. The first branch of Deutsche Bank was opened in Bremen in 1871, and in the first year of its operations, it expanded rapidly and opened overseas branches in Asia and Europe. It opened a branch in Shanghai in 1872 and another one in London in 1873. The rapid growth of Deutsche Bank faced its first major obstacle in 1914 in the form of World War I. The bank lost most of its overseas assets, but the bank recovered after some high-profile mergers and acquisitions. It was still in its recovery phase when the Second World War broke out, which brought out new scandals for the bank. Historians of the bank, yes, those from Deutsche Bank itself, say that the bank was closely linked to the Nazi regime, and it funded a lot of projects under the regime. the most infamous of them being the Auschwitz concentration camp. Instead of becoming a non-entity after the war due to its close links with the Nazi regime, the bank, however, came to the forefront in post-war rehabilitation, reconstruction, and reunification of post-war Europe. A few decades later, the Deutsche Bank began to pursue more ambitious goals, and it made a $10.1 billion bid to acquire the U.S. investment bank Bankers Trust. The acquisition was successful, and this made Deutsche Bank the fourth largest financial institution in the world in 1990. Propelled by this success, the bank decided to list on the New York Stock Exchange. The bank got almost 8 years to reap the benefits of being listed in the New York Stock Exchange before the 2008 financial crisis hit. Its share price went up from $83.97 in early 2000 to almost $162 per share just before the financial crisis of 2008. The shareholder wealth almost doubled during this period. The recession caused all of that shareholder wealth to wipe out as the share price fell from almost $162 per share to $25 per share. One of the reasons why the bank was hit so badly was because the bank was one of the biggest sellers of junk bonds. It sold approximately $32 billion worth of secured debt during 2004 and 2008. But the problem is that even the traders of Deutsche Bank were betting against the market, only to earn some quick bucks. One such trader was Greg Lippmann, former head of banks' asset-backed securities trading. He referred to some of the bonds they were selling as crap and pigs in some internal memos, while he was pitching the same bonds as less risky A-grade investment bonds. Let us pause here to understand the gravity of financial fraud Deutsche Bank was hiding and how it affected the lives of thousands of investors. Greg Lippmann, the then Deutsche employee, knew that an economic collapse was on the cards, yet the bank painted a rosy picture for the investors. The Senate committee assigned to report on the cases of the financial crisis used then trader Greg Lippmann's emails in their 650-page report as an example of the view within Deutsche Bank that the subprime market was collapsing. The report shows how the Deutsche Bank's top trader Lippmann time and again told his colleagues and some trust clients that some of the securities they were looking to buy were not so highly rated, and instead they carried a high risk and could default soon. By doing so, he made his clients gamble by selling very high-risk CDOs as low-risk.
Hi, got a small favor to ask of you. Please add your name to say.
Sorry for all the commercial guys. They're killing me on a commercial.
To unsuspecting buyers. The report stated that, at one point, Mr. Lippmann was asked to buy a specific CDO security and responded that it rarely trades, but he would take it and try to dupe someone into buying it. He also at times referred to the industry's ongoing CDO marketing efforts as a CDO machine or Ponzi scheme. Here are the examples the report uses from Lippmann's emails to show that bankers knowingly shorted the market while hawking the products to any dimwits who would buy them. From the emails, a pattern emerges. This bond blows. That's regarding a subprime RMBS security issued by Long Beach, the 24th of February 2006. This is a good pool for you because it has a fair number of weak names, but not so many that investors should balk. I wouldn't add more of these. and also has only a few names that are very good. Here he's advising Derek Kaufman at JP Morgan, 23rd of June 2006. You have picked some crap right away, so you have it figured out. That's an email to Mark Lee at Contrarian Capital, the 4th of December 2006. Then he shorted it, or covered the short by duping CDO fools and told clients to do the same. For those who do not know what shorting means, it's a financial term which means selling stocks or other securities or commodities in advance of acquiring them, with the aim of making a profit when the price falls. That said, I can probably short this name to some CDO fool. That's to Bradley Wickens at Spinnaker Capital, 30th of August 2006. This kind of stuff rarely trades in the synthetic market and will be tough for us to cover, i.e. short to a CDO fool. That said, if you gave us an order at 260, we would take it and try to dupe someone. That's to Bradley Wickens at Spinnaker Capital, 1st of September 2006. I don't care what some trained SEAL bull market research person says, this stuff has a real chance of massively blowing up. In his defense, Lippmann said that he was trying to grasp at things in order to establish that his understanding of the market was right. Soon after the financial crash of 2008, Lippmann left Deutsche Bank and joined a firm set up by Fred Brettschneider, who was the former head of global markets for Deutsche Bank in America. Later, Lippmann used his extensive experience of the financial and especially the derivative market to set up his own hedge fund in 2010 named Libra Max. Lippmann quietly made money by selling high-risk CDOs labeled as secure. Deutsche Bank knowingly allowed him to build up the market because his calls were bringing in a lot of money. They did not care that the investors would lose millions if the markets crashed. And we saw that when the stock market crashed in 2008. People like Lippmann took their money and slithered away to set up their own funds to fool the masses once again. This also shows that the Deutsche Bank had a weak internal control mechanism. It allowed its experts and market dealers to deal fraudulently. The after effects of this fraud materialized in 2014, when the bank was ordered to pay $1.93 billion in settlement to the U.S. Federal Housing Finance Agency for the sale of risky subprime.
All right, guys. So
Macy's Big
right
Home
now,
Sale is going on now with hundreds of specials.
I'm going to stop our broadcast today, and I want to say thank you so much for being with us on our live, on our Secure Your Energy live. I hope it brought you some clarity in regards to what are mutual funds versus 529s, as well as what is an investment banker and their role, as well as you can be an investment banker, you know, if you take the time to teach yourself and learn the market and manipulate it in the manner, not in the manner that they are, but manipulate your portfolio in a manner that you can control it. So thank you again for being with us today. Thank you. Many blessings, and we will see you on our next live.